All right, this is session 3 of 6. This one's entitled Winning. This one's going to talk about how you win and what does it take to win. By win, of course, we mean trading for gains overall, which I'm sure everyone listening is interested in. Now, there's a 2 or 3 items that you absolutely have to do in order to win. One is the ability to choose high probability trades. And 2 is discipline. Now here's what's interesting about these 2. The ability to choose trades, when you take the total winningness, the total ability to win, the percentage of importance or the percentage of that of each of these items is as follows. 25% of winning effort is the ability to choose trades, and I would say 75% is discipline. This is the one thing you got to get through your head. You see, too many people, especially new people, they're looking for a way to find better picks. It's all about picks, you know. It's like if they're not doing well, there must be some better way to choose a stock. So they work on new filters, new methods. Even the forum is filled with chat about this pick and that pick and, oh, do you have a better filter? And that stuff is important, and we're going to cover some of that tonight. But trust me, that's only 25% of the entire effort. The 75% is discipline. Because you can have the greatest picks in the world, and without discipline, you can still lose and go broke. You can lose, I put a note here, you can lose half of your trades. You can lose half of your trades and still pull ahead if your discipline is in. You can win 90% of your trades and lose if your discipline is out. I cannot emphasize this enough. You know, and I'm not immune to this. In a little while, I'm going to show you an example of where my discipline went out, and it set my entire tracking portfolio back. It set it back like 3 weeks by one stupid, knuckleheaded error. So I cannot emphasize this too much. Okay, but let's cover the first one, which most people are interested in, because a lot of people don't like to admit they don't have good discipline. So, first we'll cover high probability trades. How do you do that? Well, I've got 2 recommended methods. These are not the only ways, but these are the 2 ways that I suggest you find high probability trades. One is to choose from the high scores. High scores meaning in Optionality-Pro. Or 2, track a handful of reliable watchers. I'm going to cover that and show you what I'm talking about for both of these. These are the 2 methods that I prefer to choose high probability trades. By high probability trades, I mean trades that are more likely to win than not. Keep in mind, there's one thing about trading. There's no certainty, there's no sure thing in the trading world except for one, and that is you will have losers. You will have losers is the only thing that is guaranteed. So by the way, that's why your discipline is so important. But you want to minimize those losers, obviously, so you want to choose high probability trades. Okay, choosing from high scores. I've covered this in past sessions, but I'll do it once again. Okay, here's Optionality-Pro. By high scores, I mean, of course, the scores you see in the score column. Now, I'm going to cover just stocks for the moment because there's more choices, but if you're only an options trader, you'd have that on, and then you'd have to choose from the high scores in the options list. But let's just take stocks just so I can demonstrate. Now, what do I mean by choose between high scores? Well, for starters, we got 1, 2, 3, 4, 5, 6, 7 scores of 99 in a row. All right, so what does that mean? You trade all of those? No, of course not. It means you have to make an intelligent decision. The way I do this is I have this rule called room to run. Now, that's not the only thing you look at. One thing I'm going to cover a little later is market direction. You know, you've got to consider the direction of the market. Like last Friday, when the Dow lost like 300 points, that thing was just sailing down and down and down. That is not a good time to go long. I don't care what the score is. It's just a bad idea because most stocks will follow. So you have to take those things into consideration as well. But assuming that the market is neutral or up, you'd have to make a choice. The way I usually choose is see if they have room to run. By that I mean support and resistance. Okay, if you look at this stock, you better zoom in a little bit on this. You see, it likes this stock because it has a nice V bottom. Here, let me, or there's a V bottom showing or forming. See that? That little green bar, it's gone down, 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 then it's on its way up. Now, I like this stock because it has room to run, and here's what I mean. Your resistance level is right here. The only reason I know that is because that's where it sold off before. It sold off there. It failed to stay above that line. It failed to get above it there. It failed to get above it there, and it failed to get above it there. So that's resistance. However, the stock's trading right there, so it's got a lot of room to run. So that is a decent play. It's got a score of 99. That means that every time in the past it's had a V bottom, it did very, very well. You can just look at the chart and see that it's true. Look at that one right there. It went on to soar. Here's another one. Went on for 3 days. Here's another one. Went way up there. You see that? So you can see with your own eyes that that's a good setup for that stock. So I like this pick. I would put that on my top radar. High probability trade, which is what we're looking for. Here's another one, same thing. That one looks almost identical. I swear it's almost the same chart. You see, there's your resistance line where my crosshairs are. And there's where the stock is. It's got a lot of room to run. Now, I would pass on this one as a personal preference because it's a $100 stock. I don't like to trade expensive stocks like that. It doesn't make any difference, right? Like 2% is 2%, no matter how many shares you have, right? It's just psychological. I just don't like to, I mean, I like to have, 500 shares. I don't like to have, a $100 stock. I mean, you're not going to be able to buy very many shares. So it's just a psychological thing. But I would pass on it just because of the price. Same thing with that. I'd pass on the price, $70 stock. But it's interesting that it's picking all these V-bottom formations. And by the way, the reason it is because it looks at the track record of the stock and it sees that's exactly what happens. Look at this stock. This V-bottom, 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 a little mini V-bottom. Look at that. It ramps up every single time. There's even another little one there. Goes up. So you see, that's a solid performer. That's TNA, by the way. A lot of you guys picked that today. Right now, the futures, for your information, are very high. Something about Turkey, or interest rates. I don't know, but who knows? The market's been looking for an excuse to ramp the market back up. But if you guys are sitting on TNA, it's probably going to go like that tomorrow. So looks good. Anyway, you get the idea. I wish I had more examples. All these, seems like V-bottoms are the only thing panning out on the scores. Yeah, there's another one. Now, if I had to choose between these, I would skip this one for now. If I was choosing between these four, actually, I chose this one today. I'm even in on this one, SMTC, because of that nice bottoming out there. But it obviously has room to run. Look at that. Look how much room that has to run, because there's your resistance right there. So that's a good pick, but by the way, I'll answer questions here near the end of the session, because if I keep answering little questions, it's disruptive to some people, because I can see there's already some questions. Anyhow, the reason I would rule this one out if I were choosing between the ones we just looked at is because this stock is really groveling. It's way down there, and so it's kind of downtrendy. I might feel differently if it really showed some strong momentum to the upside, but if it were a tie between this and some of the others I just looked at, I would not choose that one if I had to pick only one. By the way, while we're here, you see this column here? This is a new feature you guys will have pretty soon. See, I'm circling that. You see that column? Notice those dates? That's the earnings date for the stock. Isn't that cool? The new optionality will give you the earnings date of every stock in the next, I believe it goes out about a week, more like 8 or 9 days. But it's telling me that this OCLR, its earning date is today. Is that right? It was today then. Well, okay, now here's what you do, by the way, since we're here. If you want to know when, the time for that earnings date, you look at the chart. And it says up here, earnings date 1/28/14, and it says time after the market close. So you got to get the time by looking at the chart. Now, you're going to say, Gar, why don't you just put the time in the column? Well, it's because there's real estate issues. I don't want to have this column, 9 feet wide. And by the way, you'll notice that this has replaced that arrow column. That arrow used to tell you whether the score went up or down. I personally found that arrow feature to be useless. So, especially since we have the high of day score now. Anyhow, you can sort by earnings. If you click on that, you can see all the earnings guys for today. And you can scroll down, and you can see all the earnings guys for tomorrow, starting there. Pretty cool. Boy, there's a lot of them tomorrow. Good Lord. Then on the 30th, et cetera, et cetera. Anyhow, back to high probability trades. Well, that's a 99. Let's take a look at it. That's a real cheapie too. I would consider this one, even though I don't like to trade stocks below $4 or $5. If you guys like it, this is a good one because it's right on support. You see that? Here's your support line right here. It's bouncing right off that support. It's forming a V bottom, and it looks like it could run all the way up to there. Anyhow, by no means is this the only thing you should look at. It's just, quote unquote, does it have room? But that is a huge factor. Because remember, the fact that you already have a high score means that it's already run it through the paces. It's already computed the stock's rough probability of advancing. So it's done all that work for you. But now it's your job to weed them out, to weed out the false positives and to pick a good one. One thing I want to emphasize that is it's not crucial that you're right every time. You're going to have losers, I say make the best picks you can and put your best foot forward and have a decent stop out, bail out if it doesn't go your way. Like I said earlier, you can have only 50% winners, which means that half of your trades will lose. I mean, think about that. You make 10 trades in a week, let's say, and let's say half of them get stopped out. You realize if your discipline is correct and proper, you will still be ahead. You'll be up. So it's really, really critical that you understand that the good picks is only a small part of the whole winning game. It's more in the discipline. Now, 50% is not a very good record, My own personal record is probably like 70%. I could, over time, usually 70% of my picks win. But I'm telling you something, even though that's true, in fact, I'll show you that right now that we're here in the program. This is the tracking portfolio of all the picks that I have publicly released. Right here, we're up to 67% here in late, a little after mid-January. And suddenly I held on to a huge loser way, way, way too long for a 9% disaster. That pummeled the tracking portfolio by 5%. That destroyed weeks of portfolio work. Now, and I got, my head screwed on again, and then I've just been stopped out. Okay, another error I made is on Friday, when the market is sailing downwards, I went long on 3 positions, got stopped out on all 3, served me right, so that sank the portfolio even further. Okay, my point is that those 2 errors, going long on when the market is obviously trending downwards viciously, and holding on to that loser way too long, has cost, oh my God, it's cost 8 points, 9 points in this portfolio value. So even though my winning ratio is probably 70%, see if you go through there, it looks like about 70%. So no one's perfect, not even myself, which is why I can push the fact on you guys, because I know the pain of this kind of torture when you make that error. Anyhow, I think you get the idea. We'll be going over that more and more and more. Okay, tracking a handful of watchers. Okay, we just covered choosing high probability trades by choosing from the high scores, but there's another way. And this might sound almost contrary to everything I've been talking about for 3 weeks, but this method, tracking a handful of watchers, the scores are irrelevant. Well, mostly irrelevant. You can throw away the scores and just use this method. This takes a little more practice and a little more stock knowledge. So if you're kind of a new beginner, you're probably better off doing the score thing where you choose from the high scores. But this method is really good if you're more of a veteran. And I love doing this. And let me tell you what I mean by a handful of watchers. By the way, this is particularly a good method for options trading. You could do this with stocks, but it's even better with options. By tracking a handful of watchers, I mean you carefully choose a handful of stocks that you like to follow and that you feel comfortable with. Why would you feel comfortable with a stock? Well, because it's hard to explain, but if you guys have been around for a while, there are certain stocks that just perform well for you. I mean, they're easy to call, they're easy to see the setup, and they just tend to perform well. You know, the exact opposite is true. There's some stocks that just seem to turn on you no matter what. You know, maybe it's my imagination, but that really seems true with different stocks. So I learned this technique years ago. When I first got into options, this is all I did. I found stocks that I liked trading options on. And I have listed a few of these for you guys. You don't have to use the same ones, but this is my list that I track. I right now have it sorted by price, but you can on the new version, which you guys will get late tonight, you can sort by any one of these columns on the watch list. Let's just sort by symbol. You'll notice, for starters, that most of them are ETFs. Very, very, very high volume ETFs, which are really good for options. And you know why? Because ETFs are not as volatile. Well, some of them are, especially the triple type ETFs, but they're not as prone to sudden knee-jerk catastrophes. You know, like you take like a stock like, well, Yahoo, you know. Look at Yahoo tonight, came out with earnings and it just got hammered. Well, that is unlikely with an ETF because there is no such thing as earnings on an ETF. So if a stock within the ETF gets hammered, the ETF's only going to go down a little bit. So they're more stable. So most of my tracking watchers are ETFs, but some of them are not. If they're not, they're very high volume option trades. Like, for example, I have BAC in there, Bank of America. ACI is another one of my favorites. That's a little cheapy. Some coal stock. As far as ETFs, QQQ is excellent for one and one reason only. It's because it's got super high volume options. It's not uncommon on a given day to see, like, 20,000 contracts traded on one strike price or more. UNG is another one of my favorites, natural gas. And, of course, VXX. I love VXX. VXX is VIX Futures, Volatility Index. If you learn how to trade this guy, it could be a windfall. Some of you are already starting to discover that. XLF, financial sector, I love that one. XLI, I don't trade that as often, but I like to follow it. That's industrials. I even have Ford in there, F, because sometimes it's a good one. Anyhow, here's the real question. How do you use this? How do you know when to trade them? And how do you know if it's a good one? Well, let's answer the second question first. The way you know it's a good one is that the options are good. In other words, there's a lot of strike choices, there's a lot of volume. But more importantly, is that they're easy to track. You can see the setup. For example, let's take Bank of America. This is actually textbook setup machine. Let me show you what I'm talking about. Let's just say you like to trade the V bottom. Well, look how easy this guy is. Okay, here's one. Here's another one. Here's another one. There's a little tiny dinky one there. There's one. Here's one. It's hard to see, but here's one here, and there's another one right here. It's hard to see, but there's a big long tail there. And once that thing popped up right here, that would have been a nice play. Okay, had you traded every one of these setups, you would have won here, you would have won here, you would have won here, win there. You would have broken even here, so that would have been, you might have even lost on that one. So let's put a big X there. That would have been a winner. That would be a huge winner. That'd be a huge winner, especially if you held it. But you might not have held, because I think that was earnings right there. You might not have held. So let's say that's a break even, but not a loser. And you would have won here. Okay, we had one loser, one break even, and 1, 2, 3, 4, 5, 6, 7 winners by just tracking B of A, BAC ticker. I'm going to show you a couple other techniques here, which I use a lot. And that is, this one's a beauty. And I'm going to show you guys, if you grasp what I'm showing you here, you're going to go, oh my God, is it that easy? And that's what I call the oversold reversal, which, by the way, is a filter in optionality. The oversold reversal means what it sounds like. It means something is oversold and it has reversed. I use the Williams indicator for that. The oversold reversal is a super powerful indicator. It's too simple for some of you guys that like spiderweb charts, but I'm telling you, especially when you're doing single stock tracking, like I'm talking about right now, the oversold reversal is excellent. Here's what I'm talking about. Oversold on the Williams means that it's somewhere, the Williams is somewhere in this band down here. Really oversold if it's touching the very bottommost part of the band, which is minus 100. Minus 100 will be about right there on the scale. Okay, every single time this stock, and a lot of stocks, in fact almost all of my tracking stocks, Here, let me try to erase this drawing here. Okay. Let me show you what I'm talking about here. Every time this stock is bouncing on the bottom, meaning oversold, as soon as that guy reverses, starts swinging to the upside, the stock will suddenly make a run. This is a real tiny one that I show right there, but it did make a run for 4 days. You can't see it, it's not very big, but here's a really good one. Here's a beauty. It actually literally forms a V bottom with Williams. That's really what you want to see. And look at that thing fly. Down here we have another one. See, it just sort of grovels and hovers at the bottom. Then suddenly, whoosh, you see that? It goes up nicely. There it is. Huge gains. It doesn't happen again till right here. Big spike up. That was our break-even guy. You might not have did that well because it just went sideways right there. But you wouldn't have traded this one because it's not at the low band, but that's if you're tracking the oversold reversal. But this one here would have been a beauty. There's your spike right there. And now I have a suspicion that one's going to fly tomorrow, especially if the market ramps up. Now, does this work on all the watchers that you're tracking? Probably. As a matter of fact, I only chose the ones that do track well with this. Let's look at a couple other ones. Let's pick one at random. How about QQQ? Oh, yeah. Look at that. It's a beauty. Look at that beautiful Williams V-bottom right there. That is textbook. And look at, wouldn't you know it, the stock ends up flying. This is triple Q that represents the NASDAQ 100 approximately. Here's another one. That one you had to have a little patience with, but remember this is a ETF, so it's not going to be super volatile. That ramps up nicely. It's been a beautiful call option. This one is borderline. I don't know if I'd go with that one or not because it's not that low on the Williams. I probably would have passed, even though it did ramp up. But right here's a beauty. And sure enough, it ramps up. That looks like a... See, that would have been a nice fat call option gain there, holding for 2, 3, 4 days. Now, the problem with QQQ right now, as of today's close, is it's right where you want it to be, but it doesn't have a V. So I would skip QQQ for tomorrow unless that V starts forming. Then I'd go with it. But otherwise, just get... By the way, you can go short, too. I don't see any really good V shorts, V tops. Do I? Is any good V tops? Well, there's some that are borderline. This is borderline right here. But look at that. The stock did fall. You see it, it fell right there. No good V-top. There's probably better stocks for V-tops. Let's take a look. V-tops on the Williams, by the way. How about UNG? Oh, there's a nice V-top. There's two really good V-tops we can see on this chart. One's right there. And this is a pretty good one here. It's not as good as that one, but look at that thing. Nice put options, eh? Look at that. Whoosh. Beautiful put option play. Look at that. So it works both ways. So you can track these guys. You're going to think, yeah, but what about the scores? Forget the score. But remember, like I said, if to do this tracking method, you got to be a little bit experienced, you know. You got to know how to read the chart. You got to be able to see these things that I'm talking about. You got to get the right feel for it. Then you just follow your watch list every day, and you wait for a setup, and you go, that's time to get in this one. And also, there's channeling, you know. You know about channeling, right? And that's, some of these are bad examples, but some of these are really good channelers. Let me see if I can find a good one. Here's right to it. ACI is a text. I think this, in fact, I think this is why I have ACI on my watch list. Like, check it out. Look at this beautiful channeling stock. We got line. We got support. We've got resistance. Here's a test for yourself. If you can't see that support and resistance, if you need to draw a line or you need to turn on an indicator to see that, then maybe tracking watchers like I'm showing is not your thing. Because what I keep saying, you've got to have some experience to be able to do this tracking thing. That's this kind of thing I'm talking about. I'm drawing the lines so you can easily see what I'm referring to as the channel. But I could take a look at this guy, and I can know in a half a second that that's the channel. And not because I'm smarter than all of you, but because I've been doing this for like 12 years. I've probably looked at 500,000 charts in my time. And by the way, remember, a channel doesn't have to be straight, doesn't have to be horizontal. Check out this beautiful channel. That is a textbook channel. So ACI, which is a nice cheapie, really good options action, is a really good channeling stock. Now, what do I mean by channeling stock? It means you buy on support and sell on resistance. Or you could even go call options on support and put options on resistance. Look at how many times you would have done well. Right there, it's on support. And of course, it goes flying. Right there, it hits resistance, and it goes falling. That seems to repeat every single time. It repeats there, and it repeats there. Same thing with the support. It repeats there, and there, and there. Oh, look where it is today. And by the way, if you follow Garsgold, I actually listed ACI as a possible play because I noticed that it was at its channel bottom. Then, of course, we get all reasonable. Oh, well, it's coal, and coal's not doing well, and blah, 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 blah. You know, sometimes it's difficult to keep these other crazy information out of the loop, you know. So who cares that it's coal? It's bouncing on its channel, you know. But now I admit, though, if you were choosing between this and something else, if all else were equal, yeah, I would say it's coal and that's a bad sector, and maybe I'll eliminate it for that reason. But that's only if it's tied, you know, with another good one. Anyhow, you get the idea. So these are the watchers that I use. You don't have to use the same list. By the way, I haven't been doing this a lot. Like with Garsgold, I've been going purely on the scoring. But starting now, I'm going to start using the watcher criteria a lot more heavily when I'm giving out suggested plays. And I'll try to educate as I go. See, the next big push on our business is we're going to be pushing this Garsgold a lot more. I've been kind of busy with other things, but we're going to try to make that better and better for everybody, which is why we also added the earnings calendar. The other thing we added, which I'm going to cover in a little bit, is a new directional meter. You remember the old infamous traffic light? That has been greatly improved. Not only is it improved, but underneath it, you'll see a number. That number is the actual market direction indicator. This is a whole new algorithm. I worked on this for weeks. That number, if it's green, that means the market is trending higher. If it's red, that means the market is trending lower. If you want to know the significance of that number, it generally fluctuates between plus and minus 8 or 9 or 10. A minus 10, meaning negative 10, means the market is really, really down and moving down. Plus 10 means it's really ramping up. Just to give you this in perspective, Friday, where the Dow lost 300-something points, at the end of the day, this number was negative 22. I've done a lot of back testing on this to make sure it's right. And I did it back testing in real time, meaning I used our market replay and put in this calculation and went to random sessions to see if it was right. And it was spot on every single time. The worst I ever saw, testing probably about 100 different sessions of different flavors, the worst I ever saw was minus 8, I think, or 9. And Friday was minus 22. By the way, this 1.1 means it's kind of flat as of today's close. This morning it was red, and it just ticked up higher most of the day, and finally went green about an hour and a half before the close. Just in case anybody's interested. Anyway, you'll have that feature as well. You can almost bet on it, You can almost decide whether to trade or not just on that stupid number. All right. Where are we here? Okay. This dovetails perfectly into the next point. There's one factor that trumps all of this. Market direction. Why? Because most stocks follow the market's lead. If the market's getting hammered, I don't care, short of a bear ETF, which is an exception to that, of course. If it's a regular stock or regular call option, you're going to get killed sooner or later. Yeah, there's some weird exceptions, flukes, like sometimes gold goes up when the market crashes, things like that. But for the most part, all else being equal, your long position is going to get massacred in a super downdraft. So there's different levels of that, of course. So if it's kind of a downdraft, your long position might not do so well. Now, the best way to know market direction, and one is to use the new indicator. Oh, it's a chart. There's another way, too. I want to show you a real simple way to look at market direction. One way is if you're an old veteran like me, you just look at the ticker. You look at the Dow, NASDAQ, and S&P and just kind of watch it for 10, 15 minutes so you can just see it. It's the old thing they call reading the tape. You just watch it. You see it tick up and down. You just get a feel for what direction we're going. That's usually how I do it. But if you want to see a pictorial example, one easy way is to look at the S&P. The best way to do that is look at SPY ETF, which pretty much roughly mirrors the S&P. And you can look at EMAs, for example. See now on this daily chart, it's showing this S&P is on a long uptrend right here, but then it looks like it's been on a downtrend for a few days. If you want to look at something more refined, a little shorter term, you might want to look at a 15-minute chart. I don't know what it is about 15 minutes. For something magic about 15 minutes, it shows you a pretty good intraday trend. You see here, you see this downslide. This is the last few days, and then here was Friday, right? Notice that EMA is just sort of meandering upwards, and that was exactly what happened today. If you really want to get fancy, look at two EMAs. Try using the 20 and the 30 on a 15-minute chart. Here, I'll show you. This 30. change the color so we can see the difference. Yeah, there's an oldest traders, the oldest trick in the trader book is you'd use that 20 and the 30 on a 15-minute chart. This will tell you exactly what direction the market's going. If that blue line, which is the 20 EMA, is below the other one, you're going down. If it's above that line, you're going up. That's pretty simple. If it's just kind of grinding together, you're going sideways. You can see that right here. You can almost see it perfectly. See that over here? We got an uptrend because the blue is above the purple. Suddenly they meet, and they don't cross. They just grovel next to each other. But you see the market's going sideways there. It finally goes negative here, and it does fall for part of the day, but then it goes back up again. Then it goes way negative, and then sure enough, the market crashes. Notice that those lines stay the same distance apart the whole time. That means it's a strong downtrend. If those lines start to contract, start to connect together, that means it's reversing. So if you really want to see a picture of what's going on in the market, just look at one of these. And I thought I'd show you that. But I usually don't do that. I can just look at the ticker. I can just watch the Dow and NASDAQ and S&P, and it gives me a good idea of what direction we're going. All right. There's a third method, which I promise I show you tonight, and this is when conditions are right. The third method of getting a high probability win, and that's the earnings straddle. This is what people wanted me to talk about. This is for options only, but I thought I'd throw it in here because people wanted to know about it and know more about it, because we actually did one tonight. You could have made a windfall doing one on Apple if you could afford it, which I will show you. But what is an earnings straddle? An earnings straddle is it's when you think a stock is going to make a big spike in one direction or another, but you don't know which direction. The way you do that is it's called the earnings straddle because you determine when a big name stock will announce earnings, and you believe it will spike big in either direction, but you don't know for sure which direction. And I don't care who you are or who you listen to, nobody knows for sure which direction. Not even the insiders, you know, because they're sitting there going, oh, we ought to go up because we beat estimates. And then they announce beating estimates and the stock gets pounded. So even they don't even know. Anyway, here's what you do. You buy equal amounts of puts and calls right on or very near the money prior to earnings. It sounds too easy and simple, right? But I swear, if you choose the right stock, this works. Because if the stock spikes, usually one of the two legs appreciates more than the losing side falls. Hence, you have a net gain. This could be one of the safest bets on Wall Street. Now, there are ways to lose on this, but there's no way to lose really big. I mean, short of making a stupid mistake, there's no way to lose big on this play because you're covered on both sides. But there is a way to lose a little. But here's an example. I did this on paper. The reason I didn't do this for real is because I can't play this much. My options account, my rule is I can only play $500 per trade on my options. And this would have cost $1,700 per trade. I couldn't do that, right? But maybe some of you could have. This would have been beautiful. Okay, check this out. Yesterday, before the close, Apple was trading around 550-ish, I think. I could be wrong about that, but I think it was 550. The 550 February call was going for $17.75. That is $1,775 per contract for one contract. The February 7 puts, same strike price, was going for $16.14. So to buy both of those at the same time would cost you about $3,400. All right. What happened is, after the open, as most of you know, Apple got crucified after earnings. This morning, after the open, the calls went to 60 cents. Talk about a catastrophe on a call option, but the put options went to $48, for God's sake. The result is your proceeds selling both $4,860, your net gain would have been $1,471. Now, let me ask you this. If you could afford it, don't you think a $3,400 trade is worth it to make $1,400? I mean, all day long. I mean, it's a no-brainer. Now, the only reason why this worked is because Apple went massively down. If it would have gone massively up, you would have had similar results. The time that you don't do that well on this is if the stock doesn't move that much for whatever reason. Then you're stuck with kind of losses on both sides, and commissions. But what's the worst that could have happened? Let's say Apple only went down, 1%. The puts would have been worth a little bit more. Puts would have probably been going for $18. I'm just guessing, just from experience. The puts might have been 18, and the calls might have gone down to 14. Okay, you sell both of them, and you come out, you lost maybe $100 of your $3,400 or something like that. You see what I'm saying? So this doesn't always win big, but it can. And tonight we have one on Yahoo. And so far it looks good. Yahoo got pounded really hard. The only question is how far is that going to push the put options up? And also, are they going to jam that thing higher in the morning? You never know. Futures are very green, and you never know, but we'll see. But it might be a good one. Anyhow, the straddle rules are thus. Play only the big names that everyone is talking about. Tech names are the best. This is really key. You're not going to get these big spikes on these no-name guys. I remember somebody was talking about Comcast, I think the ticker is CMSCA or something like that. I wouldn't play a Comcast because it's not a big name. Yeah, it's a big company, big market. It's a big cap stock, but it's not a big name. Okay, what do I mean by big name? I mean, remember, I'm not talking about big capitalization. I'm talking about big name, the stock that everyone's always talking about. You turn on CNBC, for example, all I heard all day long is how they just can't wait for Apple earnings. They just can't wait, When it's that kind of fever, that's your guy, that's your play. Because that attracts every bozo on the planet, and the thing goes all over the map on the after earnings trading. So, big names, household names. Here's to name a few. For example, Microsoft, Intel, Apple, Yahoo, Netflix could be a good one, Google, etc. You want these big hoopla names. They're the ones that have the giant spikes on the earnings, usually. I mean, don't do something like, Pfizer. That's a huge company, but it's not a big name. It's not something people trade heavily. You see what I'm saying? It's got to be a big momentum trading type of stock. Facebook might be a real good one when it does earnings, for example, because that's a big hoopla, everybody and their mother in on it kind of stock. If there's any doubt, listen to CNBC and see who they are squawking about all day long in anticipation. And that's your guy. Play equal amounts for calls and puts as close to the money as possible. That's very key, because you don't want to be paying for a bunch of premium. So if you're right on the money on both sides, you're in good shape, because It's hard to lose a trade like that, because if you're at the money on both sides, whatever the movement of the stock is, you're going to get the maximum movement in the option. And I also personally, when I do this earnings straddle, I like to play really as close to expiration as I can. And the reason is because you're only going to hold it for till the morning, right? You're not going to be holding it for 3 days. And you're also paying the minimum amount of premium if you're really close to expiration. Those premiums will kill you on this straddle trade, by the way. I mean, if they're too high, the stock's not going to move enough to make up for it. Okay, so to get back to the original subject, to recap, the ability to choose trades is only 25% of your winning endeavor. Discipline is the other 75%. Now, how about luck? Is that a factor? No, luck is 0%. So if you think you're unlucky at trading, you better think again, because it's not about luck. And I want to show you how and why. All about luck with regards to trading. Okay, consider the insurance companies. Now, in this case, we're dealing with life insurance. My dad was a life insurance mathematician. They're called actuaries. And so I grew up with this sort of thing. I know all about this. You see, life insurance thrives on one principle. That's you get a whole bunch of people paying premiums to these companies, and they're betting on the fact that only 1 or 2 of these people are going to die anytime soon. So if one person dies, they only pay out a little bit, even though all those premiums are coming in. Now, what happens if suddenly, by some fluke or some catastrophe, all these people die at once? The insurance companies could go broke. All right? I would call that very, very bad luck. Right? Now, when was the last time you heard of a life insurance company going broke? The answer is almost never. And I can't think of any. Well, how could that be? I thought they were just gambling, right? You know, betting on probability, which is what they're doing. Probability's on their side, and that's why they don't go broke. They have that all figured out. They have the probability of death, believe it or not, figured out. And they figure out how many people they're going to have in the pool and what their premiums have to be to beat that game. So they're like on the house side of the casino. Consider the casino. You got casino and you got players. I always laugh when people say that trading is just gambling, right? Well, no, it's not. It depends on what side of the table you're on. If you're on the player side in a casino, yeah, it's gambling. But if you're on the house side, you see, they're just shoveling their money in, right? On the house side, they only pay out a little bit. What if the players got super lucky all of a sudden? What if one evening, one fateful evening, which is probably the casino manager's worst nightmare, everybody just gets massively lucky and hits everything imaginable. Jackpots, running card tables, all kinds of things. The casino could go broke, right? When have you heard of a casino going broke? Answer is probably never. Okay, but here's the catch. Here's what I'm leading up to. There are 3 ways an insurance company or a casino could go broke. One is probability is no longer in their favor. For example, insurance company decides to only cover people with terminal cancer, or let's say casino pays more than the odds of winning. Like, obviously, if the life insurance company says, okay, we hereby have decided for the purposes of public relations that we're going to start giving out the same premium coverage to everybody with terminal cancer. Well, suddenly they've lost their probability advantage there, you see, because the chances of that person dying are almost inevitable. So they've lost their favor. They've lost their probability edge, and they will go broke if they do that. Second way is if they're underfunded. Okay, so example, you start an insurance company. I think it's actually illegal for this reason, but let's just say you start an insurance company with just a little tiny bit of money. A single claim could wipe you out, and that could easily happen, you see. So if you're underfunded, you're going to get wiped out. If the casino only had $100 at their cashier cage, they could go broke in 10 minutes, even though the odds are in their favor. This method of this madness, this is leading up to a couple of things, which you'll see. Or they violate the rules that keep them solvent. For example, the casino eliminates their house limit. Why would that ruin their solvency? Well, because if there's no house limit, some fat cat billionaire could come in there and keep doubling his bet until he beats him. Ever wonder why the house has a limit? It's for that reason. Because you could come in and say play a blackjack hand for $500 and you lose, right? So you play $1,500. You lose that. You play $2,000. You lose that, right? If they had no limit, a guy with infinite funds could keep raising that until he beats you. And then you're in trouble. So that's one reason why they have a limit. So if they decide to eliminate the limit, they could go broke. Here's the point. Profitable trading rules are identical. Which are? They're identical. Play only probabilities that favor a win. You see how these this is all lining up now? Become the insurance company. Become the casino. I mean, seriously, sit there and pretend that you're managing a casino. You're not the player, right? You're the house. You're not going to take a bad bet, are you? You're going to only take bets that you know you're probably going to win, and that's the way you have to look at it. Do not be underfunded. Now, the obvious way to be underfunded is to not have enough in your account, but there's other ways, as I'll show you in a sec. And the three is to have strict trading policies to minimize losses. Notice how these three line up perfectly with what the casino and insurance company have to do in order to stay above water. Okay, let's look at each one. Only play probabilities that favor a win. Example. We've already given lots of examples, but I have one more here for you. Take this stock here. If you were to trade it right at that resistance line I'm showing, the probability is very poor that you're going to win because it's resistance. So you're being completely knuckleheaded to do that trade because it's not a very good probability. It could bust through that resistance and then you do okay, but the chances are it's not going to. Same thing here. Very high, very low probability. However, if you're trading right here, now you're in good shape because it's already broken through resistance and now it's a high probability trade. What's interesting about that is this is the same stock, but when it marched up here, it was a bad bet. When it marched up here, it was a bad bet. But however, it marched up here, it was a great play because it broke the resistance. That's the kind of knowledge you need to have. So you look at this like the life insurance company. It would refuse premiums from this guy, refuse premiums from that guy, but this guy will go, oh yeah, we'll take your money, we'll take your premium, and sure enough, it goes on to soar. That's just a little example. I've showed you a lot of other examples earlier tonight. Here's another example. What if you had this stock here, right? You've got a nice setup right on resistance, right? It's like, let's say you're playing a channeling thing. However, the Dow is minus 150. That's a bad bet because the Dow is minus 150 and falling. It's a bad bet. So don't do it. If you do it, you're eliminating your edge. You're losing your probability, and you're becoming those stupid casino or life insurance errors. Those are two examples. By the way, see what I just did? This is what actually happened in real life with this particular stock. Look what it did. Crash-O-Rama. That was a real example. That's why I chose that one. Okay, do not be underfunded. Most obvious example of underfunded is starting with very little. But there's another more subtle example which a lot of people violate. They don't realize it's actually another version of being underfunded. First of all, before we go on, what does very little mean? Very little is different for stocks versus options, because options will be covered next week, by the way. So what constitutes very little is different amounts for stocks versus options. Here's the thing. There's the rule. No single trade should use more than 1/4 of your trading power. Well, how does that then tell you how much you have to have? Well, if you're doing stocks, if you're only going to trade 1/4 of your trading power on one trade, you better figure it out with a little calculator. You better make more on that trade if it's a winning trade than your commissions for starters. Otherwise, you'll never win. A typical winning trade should overcome at least twice what you pay on commissions. At least twice. Remember, commissions are round trip. So if you got like Scottrade and they're whooping about their $7 per trade, that's actually $14 per trade. So if you're trading $1,000, you have to do 1.4%. You actually have to do 2.8% win to do twice the commissions. It's pretty hard to get 2% on every 2.8% on every trade. So you better think twice about how much you need if you want to do straight stocks. It's hard to do the calculation, but off the top of my head, I'd say you'd have to do like $5,000 trades if those are your commissions to do reasonably well consistently. But I'm just guessing. You can figure it out on your own to see if you're going to overcome commissions or not. Remember, it's different for options because options you can use way less, and we'll cover that next week. A reasonable assumption is that a winning trade will return 1% on average. That's reasonable. Some will return 2, 3, 4%. Some of them will return 0.5%. Some of them will lose. It's good to assume it's going to return about 1%. And have strict trading policies to minimize losses. Well, I can't emphasize that enough. Here's a key component of this rule. Never let a loss significantly damage your trading power. Did you see my example earlier where I had that one huge loser? That damaged my trading power, and that was an error. You know, you guys, I have heard story after story after story from users of our products that tell me about some position they've been sitting on for weeks or even months, in some cases years, or it's this giant loser. You know, like they're down like 27% on it or something. And I'm thinking to myself, how in the world did you let it get to that point? That's the kind of thing I'm talking about. Just don't do that. You can't let it just sink and sink. You have to bail. Or you got to live to trade another day. Now, the most obvious way to allow one trade to lose too much, but there is, I'm giving you the obvious example, but there's another subtle way you can damage your account, and now I'm going to show you how. This is not as obvious as just losing a huge amount, and that is called inconsistent trade allocations. This is what kills a lot of people. Here's an example. You make your first trade. Being overly cautious, of course, you're nervous, right? Why wouldn't you be? You go in for only 1,000. You do well, returning a 2% gain. All right, cool. You say, Gar, this stuff's pretty good. Now, with more confidence, your next trade is a lot more, let's say 3,000. This time your gain is only 1%, but you're happy, all right? This is like a typical scenario. Seeing how well this is going, you decide to go all out and trade 6,000. What do you think's going to happen? You guessed it, the trade does not go well, and you bail out at a loss limit of 1%. At least you're good about bailing. And by the way, this gives you this is a small sample, but you just had a 2/3 winning ratio, so you actually did pretty good. But look, check it out. Here's how you stand after 3 trades. You are down $10. What? You did really well. You had 2 out of 3 winners, and yet you have lost $10. The reason is because of these stupid, knuckle-headed trading allocations. Your biggest trade was your loser, right? You pulled a Devon. I don't mean that derogatorily. You pulled a, well, I did the same thing once, and your big loser was your biggest trade, and that was the problem. See, they're not consistent. Now, had you been consistent, let's say you did 3,000 in each trade, you'd be up 30 on the same exact trades. Now, what do you want? Do you want minus 10 or do you want plus 30? Which you tell me. So inconsistent trading amounts is going to eat away and decay your trading power. And you're not going to understand why you're not. Guess what you're going to do? You're going to say, I need better filters. I just need better picks. That's what you're going to say, and that is wrong. You're not losing because you don't have good filters. You're losing because you're not trading properly. And by the way, everything I'm telling you totally applies to options. The only difference is options that you use way smaller amounts and the commissions are usually higher, but that's about it. It's the only real difference. So there was a $40 swing with the exact same results. I'm using this to illustrate. Imagine if you're trading a $200,000 account, there'd be like a $4,000 swing, which is pretty brutal. Always trade consistent dollar amounts and do not deviate. Note, it does not have to be exact. Don't get anal retentive about this. Just simply don't err more than a few percentage points. In other words, if you do a $3,000 trade, your next trade is $3,100, that's fine. Just don't do 3,000 and then 8,000 or 3,000 and then 1,000. Just don't do that. Another way to damage your trading power is the most common, letting a loser run too deeply. I just covered that a couple minutes ago. The story after story after story after story about people that have these giant losers in their portfolio. And I'm thinking, like it's minus 29%. I'm thinking, duh, shouldn't you have thought about it when it was like minus 5? And they say, yeah, but I can't sell it now. Okay, then you're going to sell it when it's minus 60%? It doesn't make any sense. So the question is, what is too deeply? How do you define how deep a loser needs to be? There's no clear-cut number. I'm not going to sit here and tell you, well, always cut your losses at 1.9%. No, nothing like that. Here's the answer. The answer is when the loss goes beyond the point in which a recovery is unrealistic. So that depends on a lot of factors. First of all, it depends on what your typical winning percentage is. Second thing, it depends on the price of the stock itself. Like if you're trading a $5 stock, it is not outrageous for that stock to go plus and minus 5-6% because it's so cheap. So you might let it run. Sitting on a minus 5% is not the end of the world because that stock could easily ramp back up. But if that thing goes to 7, 8, 9, 10%, yeah, it's time to bail out on that thing. Why? Because it's too unrealistic that you'll recover. And so you got to look at the situation and decide what is realistic and what is not realistic for recovery. And that is your loss point. Example, if your typical winning trade is plus 2%, then letting a stock drop below 2% becomes unlikely you will recover. Because for it to drop, say, 3%, if you usually only do plus 2% on a trade, that thing's got to do better than that just to break even. So you're better off just selling the stupid thing and using that money for a better trade. Always be willing to take a loss when letting it run further becomes too difficult to recover. It's hard, it's tough, human beings do not like to be wrong, and that's half the problem. And, you're thinking, yeah, but if I sell it now, it's going to ramp back up the moment I sell it. Yeah, I've heard all the excuses. I've made those excuses myself. But believe me, if you don't fall for this sucker thing of letting them run too deep, you'll do fine. If you let them run too deep, you will get killed. Last topic is emotions. Okay, this is an interesting topic because most or many will tell you that emotions must be kept out of trading. All right, that's what you hear everyone tell you, right? I say balderdash. Seriously, I say that that's almost impossible. The last I checked, I don't think we have any Vulcans in our user base. You'd have to literally be a Vulcan to trade with zero emotion. So there's a better way. The proper thing to do is to apply normal emotions in reverse. What does he mean by that? I will tell you. It's called fear and hope. If you learn one thing and only one thing tonight, learn this. The problem with human emotion when applied to finance is that fear and hope are applied backwards. Example. Trade turns against you. Boom, you're suddenly down 2%. This never happened to you, right? Okay, so suddenly it's red 2% and you're like in despair. Instead of bailing, guess what typical human being does? You hold on and hope it will recover, right? Am I right? The trade worsens. You keep hoping and hoping as it sinks into loser hell. I can't sell now is the usual excuse. Okay, hope is applied to this loser and it worsens. Now, on the other hand, your trade goes well. It gains, say, 1% really quickly. And you're going, woohoo, and you're excited. But guess what sets in? You suddenly fear that it will turn on you and you'll lose your gain. So what do? You sell way too soon from fear. Stock goes on to gain 5%. You've never seen that, right? Here's the deal, folks. You hoped when you should have feared, and you feared when you should have hoped. This is the damnedest thing. By the way, I did not invent this. I got this out of Autobiography of a Stock Operator, written by the great trader Jesse Livermore, probably the greatest trader of all time. He had a whole section on this, and it stuck with me ever since. The correct sequence is, when your trade turned on you, instead of hoping, you should have been fearful for a loss and bailed. You should have been so scared of losing, or you should have been so afraid that that thing would worsen that you'd bail on that trade, okay? That would have been the correct reaction. But instead, you went on hoping. When your trade went well, you should have remained hopeful it would deliver great gains because you made a great pick. So you should be pessimistic with your losers and optimistic with your winners. Hence, applied fear and hope in reverse. And understand that when you do it backwards, like I showed you 2 minutes ago, that's human. Human beings have a tendency to apply these backwards when it comes to things like financial matters. I don't know why, they just do. How many people are in money trouble? There you go. That's because of, believe it or not, it's because of this one thing. Humans tend to apply hope and fear in reverse when it comes to financial endeavors. Perhaps it is why so many people have money problems. Oh, I hope I can pay that credit card back. You know, that's true. It applies to that. Like if you rack up a credit card balance, if you did fear and hope in the correct sequence, you should be so fearful of that balance that you work like hell to pay that down to zero. You see? But on the other hand, people all of a sudden start making pretty good money. What's the first thing they do? They go out and buy stuff on credit because they're afraid to spend the money. I mean, it's weird, but financial matters, people have fear and hope backwards, and that comes to trading in a big way. That's all I have tonight, and I hope that was enough for you, and I hope you guys had some realizations and learned something new. And I can now look at all these questions that have been stacking up. Let me see with the questions here. Somebody said, when would you put on the trade with the V-bottom? Well, as soon as it's forming, and as soon as, and if you're convinced that it's going to, that it's solid setup, and then if the market's in your favor, that's the only criteria you need. And remember, you're not going to always be right. You know, this is why I really pounded tonight on this thing about you will have losers. You know, the worst thing you could do is to sit there and watch setup after setup after setup, because you're so scared to get in, you just let one after another get away from you. A lot of times, and I'm guilty of that myself, especially when I'm announcing on Gar's Gold, because I feel all this responsibility. I want to make sure I'm giving out winners, right? So I'm very cautious. But a lot of times it's best just to throw caution to the wind. You have a good setup, it's a good score, the market's in your favor, go for it. If you lose, you lose. Just bail out at the right time. Okay, let's see here. Somebody says, how about Walt today? WLT? That might have been a good one. I want to look at that real quick. It's probably a nice V. That's my guess. Let's see if that's true. Is it true? Is it true? Is it true? Oh, we're on a 15-minute chart. Yeah, you can see that V bottom. Oh, I'm zoomed way out here. Yeah, look at that nice V. I don't know if it'll go up tomorrow. It might. But that thing actually, in fact, I remember watching that today. Yeah, I remember watching it for that exact reason, that nice V. Now, one of your problems here is the stock. Well, the market here would be very important, because I think this will go up tomorrow again because the market's going to rise. But if the market was going to crash tomorrow, this thing would probably fall along with it. So, yeah, that looks like a good setup to me. Somebody says earnings date is new. Very good adding. Yeah, it's new. The earnings date thing, you guys don't have that yet, but I'm gonna get it updated tonight, I hope. The only reason it's not up there now is I got to wrap up the Mac version, which these days doesn't take that long like it used to. You'll know it too when you run the program. It'll tell you there's an update as soon as there is. Okay, somebody asked here, would number of advances versus decliners be more direct indicator of stocks following the index? Yeah, you can look at the advanced decline line. That's not a bad way to see the market direction. The only thing about the advanced decline line, though, is you got to, a lot of times it's relative, meaning that let's say that there's 2,000 advancers and 3,000 decliners. That means it's a down market, right? You look away and you turn back and you see the decliners are smaller and the advancers are slightly larger. Even though it's still negative, that means the market's rising. So you got to keep your eye on that because they're relative to each other. If they're changing to the upside, that means the market's starting to revert upwards. And it might take a while for that advanced decline line to actually go positive, is what I'm saying. Where can you find previous earnings on a stock to see their history of earnings announcements? God, I don't know. Yahoo Finance, maybe? They have this thing called earnings calendar, I think. I'm not sure. I don't know if that'd be valuable information or not. A lot of times these stocks, the way they behaved last earnings doesn't necessarily mean they'll behave that way this time. What I do find is often a factor is whether or not they're running up prior to earnings. Call me a skeptic, but when these stocks go ramping up right before earnings, they almost always get pounded down. It's amazing to see that. I mean, there's some exceptions, but I swear more often than not, if that stock's ramping up prior to earnings, you can almost get away with just doing put options, you know. But I wouldn't suggest that because that's still just a crapshoot. Somebody says, how do you play the freeze in Florida fruits and veggies? Geez, I don't know. What is your typical stop, percent or points? And when you did your straddle, did you or would you recommend putting stops on both the call and the put on a straddle? No, I wouldn't do any stops on the straddle. Absolutely not. Because the straddle is just the whole idea of it is to have have one of the sides win nicely. Then you, as soon as the options settle down in the morning, you sell it. Sell both sides if you did really, really well. Or you can sell the winning side and just sit on the losing side and hope that it ramps up. But no, you don't need any stops for that. You just have to, you're only going to trade it for, what, a half hour the next morning? As far as a stop on a stock and or option, I usually don't go by a hard percent. What I do on a stock stop is I look to see where support is, near-term support, and I put my stop slightly below that mark. Because my theory is that if it breaks support, it's toast. That could be 1%, 2%, or even 3%. That's the way I do it. Now for options, I have a general rule. I don't think you should ever allow yourself to lose more than 50% on an option. I'm just fine. I don't know. That's no magic number. It's just I find that that's the optimum number to lose on an option and still trade another day. Try not to lose 100%. I've done that. I've done that and gotten away with it, oddly. But you can only get away with that if you have a nice fat winning percentage. 50% stop on options is a good rule. Question: when will the new version be available to download? I hopefully sometime tonight. Worst case tomorrow morning. You will know it's available because if you launch the program and it's available, it'll prompt you. It'll say there's a new version of Optionality-Pro or whatever. Larry makes a comment, optionality is getting better and better. Yes, it is. That's the good news. The bad news is we haven't had a lot of new people since we had that nice free webinars, and the price went up, and all of a sudden the sales quit. So I'm complaining. We'll figure out what to do about that. But yeah, it's always going to get better. I'm also going to be working on improving the database of stocks. You know, I'm seriously considering this, and I'm reluctant to do it because there's still a couple of users, but we are seriously considering nixing, getting rid of the UK stocks. Because here's why. Because our data feed is limited to a certain number of symbols. Else we pay thousands more for it. And if we could get rid of the UK side, that gives us about 500 more symbols we could add to the stock database. I think we might do that pretty soon, even though there'd be a tiny, tiny, tiny little group of users that'll complain. Will you be adding options watch to the standalone GARS Gold in the future? Oh gosh, I don't know. I might. But remember, here's the deal about that is that the question is, shouldn't a person have to own optionality to get option suggestions? I mean, it's a good question, business question. Whether it's GARS Gold or not. I got to think about that one. Somebody still wants Fibonacci app, or whatever, however you pronounce that thing. Yeah, I know. I can only do so many things at once. Look, if you guys go out and drive some new people into our shop, it'll, believe it or not, that'll free us up to get some more stuff created. Because we spend all of our time trying to, get people in. Any other questions? Next week we're going to, no, I'm sorry, Thursday will be one more session on just general trading. And we'll start covering a little bit of options also on Thursday, only because there's not enough material to cover too much more about stocks. And then next week will be all about options. All right. Somebody asked, any way to display the ex-dividend dates? No, I mean, I don't know. I mean, yeah, there's, of course, there's a way, but I'd have to get the data feed for it, figure it out, put it in the program, do an update, get it on the PC and Mac. That's, it's a lot of work to do these things. I don't find that information valuable as far as I'm concerned, unless somebody else thinks it's valuable. All right, any other questions? If not, I'm going to